A lot has been written about so-called robo-advisory firms of late. Too often it appears that the discussion comes from one side or the other of this debate, rather than from a considered, thoughtful analysis. We think we can offer some insights into this discussion based on our 20-plus years of experience in this industry. Very simply, a robo is a website that offers asset allocation models of mutual funds and/or exchange-traded funds, or ETFs. Soon, some of them will be offering actively managed investments in addition to these passive models. The concept is not new in the 401k plan space, but it is a somewhat recent development for investors' taxable dollars. The jury is still out and will be for some time as to how these new resources may affect the industry. Let's take a look at the pros and cons. First, the pros. Robo-advisors may be a good idea for some investors accustomed to doing business via the web. The programs use very low-cost investment vehicles. The program fees are also very low. Taxes are typically taken into consideration when making changes, and the programs often maintain your risk profile through periodic rebalancing. And now let's take a look at the cons. Robo-advisors lack the ability to offer sophisticated financial planning, and interaction with a seasoned investment professional or planner is typically unavailable. Furthermore, they can't answer simple questions about your account or the markets, as you must interface with a website. And perhaps the Achilles heel of these web-based advisors? How will they calm nervous investors when markets crash? We don't believe that a pop-up screen encouraging investors to stay the course will suffice. So what are some reasonable observations about this model? We call robo-advisors a disruptive technology, and we believe that may be a good thing for consumers. It forces the industry to take a good, hard look at how they do things, and it may help them to reinvent themselves, to some extent, or eventually die. Two great industry examples are travel agents and real estate agents. Travel agencies have shrunk dramatically in number, as most travelers now log on to one of many travel sites that can book air travel, hotels, as well as car rentals. This process is, for the most part, quick and easy. Real estate agents, on the other hand, were the targets of robo-agents many years ago, and the robos failed rather spectacularly. There may be many reasons, but certainly one of them may be that consumers are less intimidated transacting business via the web with a relatively small amount of money, such as booking a trip, versus buying a home, which is one of the largest expenditures that one's likely to make in one's lifetime. Rather than driving them out of business, realtors discovered how to adopt these technologies to help with the large volume in their businesses, and they've continued to dominate their industry. We believe that financial advisors may ultimately fall more in the camp of realtors than travel agents. Making important financial decisions with one's life savings is a big-ticket item, and one that many investors won't be comfortable entrusting to a website anytime soon. At this point, we think that many advisors will ultimately offer a web-based service for those clients who wish to leverage technology to achieve a very low-cost structure. Those clients that require higher levels of sophistication in their planning, who value guidance and discipline, and who feel more comfortable being able to interact with their advisor as needed, will continue, we believe, to happily pay for those services. To learn more, contact your financial advisor or visit us at symmetrypartners.com. This is Pat Sweeny from Symmetry Partners. Thank you for your time.